Hello, and welcome back to the Fintech Takes podcast. This is Fintech Recap, so your monthly recap of everything that's been happening in and around fintech. My name is Alex Johnson. I create Fintech Takes, and I am joined, as always, by my partner in crime in this endeavor, the wonderful Jason Mikula, calling in from somewhere in the world. Jason, great to see your face.
Great to see you. Yeah, we're almost in the same time zone. I'm in Mexico City at the moment, so Central Time, which made this a little easier to schedule than normal.
It did. It did. Yes, I appreciate your being in like a time zone no one cares about, because like normally, like unless it's Central or Mountain Time, I'm constantly dealing with people Eastern Time or Pacific Time, and what I've observed is people in those time zones sort of just assume that everything exists within their time zone, and I'm sure you get this a lot too, where it's like someone will send me a request for a meeting and they'll lay out some times that they're available, and they won't include a time zone, and I'll be like, is this Eastern? They're like, oh yeah, sorry, Eastern. And it's like there are other places in the world, but I'm glad that you're in Central Time Zone so you can be equally sort of ignored in this fashion.
Oh, 100%. Classic follow-up email that needs to be sent. But you and I are going to see each other in person soon. I mean, by the time this comes out, it'll be maybe another week or so until we're in Las Vegas.
That is absolutely right. Yes, excited to go to Fintech Meetup. This will be my second in-person Fintech Meetup. I was not able to go last year because it overlapped with my son's birthday. And honestly, if I can have like a semi-valid excuse to not go to Vegas too much, I'm not like gonna like run away from that excuse. But having said that, I am very excited for Fintech Meetup. I'm very excited to see you, Jason. I think unfortunately our panels that we are moderating are at the same time, so I don't think I'm going to get to see yours. But what are you moderating a panel about?
Yeah, I mean, I am the designated banking as a service reporter, moderator, commentator, analyst, and so I am moderating a panel on sort of like the future of banking as a service, and I believe all four panelists are on the intermediary platform provider side. So it'll be Itai from Unit. Roy, formerly of Bond, who's now at FIS. Hold on, let me see if I can do this. And two more people I'm embarrassingly forgetting off the top of my head. So please don't be offended. Um, Treasury Prime and somebody else I can't remember right now. So it promises to be a good time. And you're, I believe, doing a session with one of our mutual friends, Rory from Not, and some other people. Is that right?
Yes, that's right. I'm doing one on open finance. I don't think I'm considered quite the like indispensable expert on open finance the way you are with banking as a service, but it is a passion area of mine. And yeah, I'm doing one on kind of the future of sort of open finance and what that's going to look like. Rory from Not is one of my panelists. I believe I have someone from Plaid as well. I'll join you in being embarrassed and not being able to keep all the proper nouns in my head as we're talking, but it does promise to be a very good panel. Jason and I will judge just our lives based on which one of us gets more people to come to our panel at the same time. So folks listening can consider this like my plea as Alex to please come to my session and not Jason's. It's just a little moment of competition between us, but genuinely really looking forward to it, and looking forward to getting to spend some time with you in person. Should be fun.
Yeah, and you and I can catch up and trade notes on what we missed in each other's respective sessions after the fact.
I am looking forward to that. I just want to make sure that you're in the right room and your panelists are in the right room this time, because there was a time last year when that was not the case. So, like, assuming everyone gets where they need to go, I'm sure yours will be very well attended. And I actually am genuinely sad to miss it because, as you know, I'm a big fan of banking as a service. Ironically, despite the fact that we often make trips to Bass Island, we will not be doing that on this podcast because I'm not going to say everything's been quiet. I think there was actually a consent order, but we'll skip that for the moment and we will focus on other things. Jason, the last, I swear, 3 podcasts I've done have all started with what's happening in Washington, D.C., what's happening from a regulatory perspective. And I don't think you and I have gotten a chance to podcast about that, even though I know we've exchanged many messages. So if it's okay, can I give you a little recitation of what's happened? And then I'd love to get your thoughts on it.
Yeah, please do, because I have been following along, but the pace of updates, particularly from Evan at Bloomberg Law and from
Yes.
Brendan, I think it is, at Punchbowl News,
Yep.
has been fast and
Yep.
furious. And I have absolutely not been able to keep up with every twist and turn. So please let me know what has been happening in Washington, D.C.
Okay. Well, I shout out to Brendan and Evan for doing the hard work. We really appreciate all of the reporting that you all have been doing. We hope you're getting some sleep as well. It's been very busy, as you outlined. By the time folks listen to this, it might be tragically out of date, but at least we'll get to comment on where we are right now. And where we are is, as you know, Russell Vought, who is the director of the OMB, newly confirmed, and is the acting director of the CFPB, has replaced Rohit Chopra in that capacity, and is, as our mutual friend Rob Blackwell described to me in a podcast that I recorded with him, basically engaged in a process of turning all the lights off at the CFPB, both figuratively and literally. So this has included basically shutting down the CFPB headquarters in Washington, D.C. I was actually there the week before it got shut down, so I was like one of the last people to see it in its sort of prior capacity. I think they actually have taken like the sign off of the wall in the building, if I saw a tweet correctly. So like physically shutting it down, but also essentially trying to sort of grind its work to a halt. So there's been an instruction to stop the staff from doing any work whatsoever. This is not, in some senses, unusual, but normally it's kind of a, hey, new administration coming in, can you pause everything for a moment so we can figure out what's happening and then we'll tell you what to do? This is not that. This is do not do anything, including continuing to involve yourselves in any active litigation that the Bureau is involved in, any supervision work, any enforcement work. Please pause everything. He has also announced that he will not be accepting any additional funding for the CFPB. And he has both fired and attempted to fire a very large number of CFPB employees. So, according to the numbers I've seen, they have already fired about 70 probationary employees, meaning employees who are either new to government service or new to the CFPB, having transferred from a different government department. Probationary employees are a little easier to fire. And so they've fired 70 probationary employees at the CFPB and 70 to 100 what are called term employees, which is just a different designation. And those folks were, in a lot of cases, working on some of the more sort of big tech or tech-oriented areas that the CFPB under Rohit Chopra was working on. So that is the story at the CFPB. If we were to skip across town over to the FDIC, another building that I walked by when I was in town and was not expecting anything too dramatic to happen, at the FDIC, there's been about 170 probationary employees who have been let go. That in addition to about 500 FDIC employees who took the Trump administration's deferred resignation buyout offer. So think of these folks kind of the opposite in some senses of the probationary employees. These are usually folks who've been there for a long time, are closer to retirement. The FDIC is actually staffed by a pretty large group of employees. I think it's 6,000 plus, and a large percentage of those folks are relatively close to retirement anyway. So 500 accepted that buyout offer and will be leaving. Collectively, that represents about 10% of the FDIC's total workforce. So a pretty significant reduction. Acting Chairman Travis Hill has said that the FDIC is going to be smaller than it had been previously. So sort of acknowledging that this is something that is representative of the direction that at least he envisions for the agency. And then finally, representatives from the Department of Government Efficiency, not a real government department, just to be clear, have been spending some time at both the CFPB and FDIC candidly, it's not really totally clear what they've been doing. So we know that they've gotten access to a lot of the sort of sensitive systems and data that the FDIC and CFPB have. They've been going through a lot of that data. Ostensibly, they're looking for waste or areas to save money or to be more efficient. The fact that we don't really know what these 19-year-olds are doing is a little concerning to me, but we know that they're in the building, which is by itself interesting. And then just to sort of round out the regulatory news, we have a couple of updates, I think, Jason, since the last time we talked about folks who are either in charge or who are going to potentially be in charge of these agencies. As I mentioned, Travis Hill, former vice chairman at the FDIC, has been appointed to be acting chairman of the FDIC. Jonathan McKernan, who was formerly Travis Hill's colleague on the FDIC board, has been nominated to be the new permanent director of the CFPB. Rodney Hood, who formerly was the chairman of the NCUA, the organization that oversees credit unions, has been appointed to be acting comptroller of the currency. And Jonathan Gould, who is a former senior deputy comptroller and chief counsel at the OCC, has been nominated to lead the OCC on a permanent basis. And then, Jason, I promise I'll stop giving you this fast and furious set of updates. One last one. It was reported by the Wall Street Journal that the Trump administration is mulling whether to consolidate the bulk of bank supervision inside of the OCC. And there's been some reporting, most recently from our friend Evan at Bloomberg, that the administration might be sort of preparing to start transferring employees from the FDIC and CFPB to the OCC. I saw that the OCC had pushed back on that characterization, so little hard to say, but there does seem to be an intent to at least explore the idea of consolidating prudential and consumer protection supervision and enforcement underneath the OCC. So, Jason, I have lots of thoughts on this, but I haven't gotten your thoughts on the record, so I'm just going to stop there. What do you make of this?
I have so many thoughts, per usual.
I figured you would.
Yeah. I will say that I have learned far more, frankly, than I really care to, about how the appointment process works, including specifically the Vacancies Act. I'm not afraid to admit when I'm ignorant of how something works. And in my head, it was like you appoint somebody as the acting until that person is confirmed as the permanent. But as I now realize, that is not, in fact, necessarily or even commonly how it works, right? And so there was this very kind of odd and quick succession, specifically at the CFPB, where Treasury Secretary Scott Bessent, once he was confirmed, which is required under the Vacancy Act, was for 4 days or something, was the acting director of CFPB. And then once the OMB guy, Russell Voigt, was confirmed for that role, he then, which was sort of widely anticipated, became the acting director at CFPB, continuing and undertaking the actions that you're describing. I will say that we really shouldn't be surprised at what's happening both specifically at the CFPB and beyond, given that Vault was a key architect at the Heritage Foundation of Project 2025. I'll admit I did not read all of Project 2025 because it covers a lot of different areas, and it was 900 pages, or 922 pages. But I did, a couple months back, review the section specifically on the financial services regulators. And some of the key things it called for, which it seems like are now, if not coming to fruition, at least they're beginning to attempt to implement, include, and this is explicitly what Project 2025 called for, abolishing the CFPB, combining the OCC, FDIC, NCUA, and the Federal Reserve's non-monetary supervisory and regulatory functions, eliminating restrictions on banks engaging in non-banking activities, including, and I actually don't disagree with all of this, including by creating new charters for financial firms that eliminate activity restrictions and reduce regulations in areas like payments, fintech, etc. repealing parts of Dodd-Frank, which created the FSOC, the Financial Oversight Stability Council, on and on and on and on and on. there's too much here for me to list. But my main point is, we shouldn't be surprised to see that the Trump administration broadly is moving to implement these measures. Something that I'm particularly interested in is seeing how this sort of Project 2025 wing, what the sort of intersection with the more populist corner of Trump's stakeholders and of the Republican Party is. I think folks listening to this will likely be aware that Trump during his campaign floated a 10% cap on credit card interest rates. Josh Hawley, Republican senator from Missouri, together with independent Senator Bernie Sanders from Vermont, actually introduced a bill to do this. I think it's incredibly unlikely that that actually happens, but it does illustrate that there is this tension between this sort of deregulatory, gut the CFPB, roll back the regulatory apparatus at FDIC and other places agenda, and this more pro-populist agenda. And at least at the moment, it certainly seems like the momentum is with the gut the regulatory establishment set of stakeholders. I do think it's quite interesting. Fed Chair Powell was asked about some of this during his recent appearance in front of the Senate Banking Committee and the House Financial Services Committee, given that the CFPB only has responsibility for supervising consumer compliance for banks with more than 10 billion in assets. And so now you have this kind of very odd situation where the country's largest banks, JP Morgan Chase and Wells Fargo and Citi, et cetera, in a sense, potentially don't have a consumer compliance regulator that's actively supervising them as far as their compliance with the statutes and regulations that the CFPB is empowered to enforce. But for smaller institutions that are supervised by the Fed and the FDIC for consumer compliance, nothing has changed, which is just a very, very odd situation to be in. So I guess those are my immediate reactions to sort of what has elapsed and where things seem to be heading. I suspect that if not already, we will see some fault lines emerge across different sectors of the banking system, particularly in that sort of like small bank versus large bank differential. So I'm very curious to see sort of how this continues to unfold, particularly if the CFPB truly is abolished, which we should note would require an act of Congress. Where does that supervision and enforcement responsibility for large banks go? So a lot of unanswered questions here is sort of my takeaway.
I think that's right. Yeah, I mean, we don't know, right? Like that's the thing that's so challenging about this. I think you did put your finger right on it in terms of the idea that there are multiple sort of factions within this, and this has come up in other conversations that I've had on this, where it's like you kind of think about who's driving the bus, who benefits from this type of stuff, right? And like nominating McKernan to be the full-time director of the CFPB, that's just not consistent with the vision of basically like destroying the CFPB and having it go defunct, right? Like there's no real reason to nominate someone like McKernan, who's a pretty well-respected, sort of in the mainstream, obviously Republican, but like very sort of pragmatic business and banking regulator. Like he's pretty mainstream. There's no real reason to put him in that job and also be trying to sort of gut the CFPB at the same time. And so it does speak to these sort of like almost conflicting objectives within the Trump administration. So I think that's absolutely right. I think the other thing that you touched on that I just want to sort of add my +1 to is there are parts of this that I actually don't oppose in theory. You know what I mean? So it's like when this is part of my problem with Doge, right? It's not that I don't want the government to be more efficient. I would love it if the government was more efficient, right? And I think the flirtation with consolidating all of the regulatory agencies under one roof, which is not a new idea and has been discussed and even attempted at many times in the past. Like, it's not a bad idea, right? Like it is inefficient to have enforcement and supervision spread across multiple agencies. And you've seen some of the outputs of this, right, Jason? Like, you have guidance from regulators, and the agencies will all have to create interagency guidance that they will fight over and wrestle over for months or years before they get it out to the industry. There's no reason for that to happen when they all have roughly the same goals. It's just different parties with slightly different viewpoints or slightly different objectives. So there is a lot of inefficiency built into our current regulatory structure. I also am of the belief that you could apply technology to just make bank supervision much more efficient, right? It should be much more of a data-driven exercise. I remember this is a couple years ago now, but kind of before Bass Island emerged from the ocean, there was a question, I think, from acting comptroller Sue at the OCC at the time, and he was kind of commenting that the OCC didn't actually know how many of the banks it supervised were doing banking as a service. And like that struck me and has stuck in my head because that's like a data problem, right? Like there is no reason why we can't make that type of information, that type of view into the market for regulators, something that they just have at their fingertips, sort of facilitated by data, dashboards, reporting, monitoring, all the things that sort of anyone in the private sector already has. So I'm not opposed to a lot of this theoretically. The thing that I struggle with, and I think you and I are probably on the same page about this, is that the way it's being done seems to be sort of purposefully chaotic, and in some cases kind of purposefully cruel, in a way that I think is actually counterproductive to the sort of stated goal of creating a more efficient regulatory structure that works better for the market. And I'll give you just one example of this. I find the firing of probationary employees to be pretty disturbing. And the reason I say that is, like, these are folks who are, and this was actually reported in the case of the FDIC, like these are folks who are new to government service. Like these are new people who are coming in. And the critique of the FDIC is it's old, it has a bad culture, it has these people who've been in these jobs for a million years, they won't listen, they're not open to innovation. Well, guess what? Like, younger people who are newer to government service are the exact antidote to that critique, which I think is a fair critique of the FDIC and other agencies. Getting rid of them just because they're easier to get rid of, because they're probationary employees, but not because they're the right ones to get rid of, really speaks to a sort of slapdash and ill-considered approach to going after these goals, which again, philosophically, I kind of share. Does that make sense or resonate with you?
Yeah, absolutely. I mean, I feel like we get into dangerous territory because I try not to get, too overtly political. But I mean, this inherently is like an overtly political story, and it does.
Is. We're being dragged into it against our will.
I know. I would prefer not to go there, but it does feel like the intention. Or at least let's say one or part of the intention is to break government, and not that it worked perfectly before, because I agree with all of the points you just made, and somewhat surprisingly, aspects of the Project 2025 proposal as far as sort of like rationalizing the regulatory structure, which I think I was reading something earlier today that called it an accident of history that it is structured the way it is. However, to your point, the approach of just sort of going in there like barbarians at the gate and like pillaging and breaking, to the point where I couldn't find this while we were talking, but there was some small story about like some esoteric mortgage data point that the CFPB maintains that if they stop maintaining would like functionally break certain parts of the mortgage market. And so while a sort of move fast and break thing break things Silicon Valley ethos might work at a place like Twitter, the government is not a social media network. And it certainly feels like part of the intention here is make government work even less well than it did previously in order to go back to whoever, voters, advocates, and say, look, this is so broken, we should probably just get rid of it, cut the budget, move certain capabilities or functions to the private sector or whatever. And so, I don't think it's unwarranted to have somewhat of a cynical frame of analysis here, because I feel like it's justified based on a lot of the actions that we've seen taken so far. And yeah, apologies for getting explicitly political, but like it's very difficult not to in this story.
It absolutely is. Yeah, I mean, I just to put a final capper on this, I was just walking around Washington, D.C., minding my own business. My feet just happened to walk me by the CFPB headquarters. And it wasn't my fault that there were two women outside holding up signs and yelling and protesting, specifically protesting Elon Musk because Doge had showed up at the CFPB and they, I guess, had found out and had followed them there to protest outside. Like, this story landed on me. I was not trying to like seek any of that out. I did get a good picture of it for posterity's sake. So completely agree with everything you just said, Mr. Mikula. Let's go to another story, which is not political, but is one that I think you've been covering for a long time and have quite a relationship to. So why don't you walk us through it?
Yeah, absolutely. This will be a good palate cleanser. So Varo, this is a bit of a throwback to the FinTech 1.0, so to speak. But I do think it's worth revisiting, particularly as Varo was the first fintech to secure a de novo bank charter. So there's been a decent amount of activity in the so-called charter strip acquisition space, GECO and Column, SoFi, and others. But there's been fairly minimal activity in the de novo bank chartering space. The pace of new bank creation really slowed to a crawl after 2008, and that has been true across administrations of both parties. So it hasn't necessarily been like explicitly a Republican versus Democrat issue. Now, the first news story here is the bit that Varo's founder and CEO, Colin Walsh, is stepping down to be replaced by Gavin Michael, who spent the last 4 years as CEO of the crypto custody and trading platform Bakkt. Don't know how to pronounce that. I have heard that Colin's departure was linked to a fundraise effort. So basically, in order to raise new capital, there was a, let's say, ask that he step down as CEO. And the piece about the fundraise was subsequently confirmed by Crowdfund Insider, who clocked an SEC filing showing that Varo had raised an additional $29 million in equity. Now, I do want to pause here to acknowledge I've heard some criticism of my coverage of Varo in the past, so I will reiterate, I think Varo offers a good product, a better product for lower income and lower credit score users than mega banks, as well as some of the more questionable cash advance app type services. But there is a but here, and that is it's very difficult to serve this customer segment in a way that is transparent, compliant, and profitable. Those three things are all very key. You can serve this segment, maybe not super transparent, not super compliant, and be profitable. Very, very difficult to do all three of those at the same time. And taking a look at Varo's most recent call report really demonstrates this. The bank has narrowed its losses, but it still posted negative $65 million in net income last year. And despite spending $19 million in 2024 on marketing and advertising, its deposits barely budged, its assets actually shrank, and the quality of accounts it has is consistently fairly poor if you're measuring that based on average deposits per account, which remain at about $65 as of the end of 2024, and average revenue per account, which was a paltry $32 last year. Varo is primarily an interchange business, even though it has this bank charter. 56% of its revenue came from interchange last year. And the credit quality of the types of lending it does, which is a sort of small dollar product called Varo Advance, and actually a sort of I believe the term is open secured card, Varo Believe, which is its credit building card. It's not even really credit in the traditional sense. Charge-offs on the advanced product is annualized rate of 28% in Q4, and on the card product, it was 2.37% annualized in Q4. So I think the highest level question is like, what went wrong here, and what is Varo's path forward? I mean, Alex, when you sort of absorbed this information, how did you sort of contextualize it?
Yeah, I mean, I will start by re-emphasizing a point you made, which is that I like Varo, right? So this whole like us being critical of it, it's solely based on its ability to make money and be profitable, which are requirements for it to be sustainable in the market and to stick around. But like I want this type of thing to exist, right? And I think generally speaking, Varo's products demonstrate sort of a desire to do right by this customer segment, which is very, very difficult to serve. I have my critiques of their credit builder product, which I won't get into because I'm trying to keep my blood pressure down. But in general, it is a very good set of products, responsibly built, serving a segment of the market that's not well served by traditional financial institutions. And that actually ties to, I think, my overarching take on this, which is Chime is sort of the obvious counterpoint here. But the difference in the paths that Chime and Varo took, as you illustrated, is one got a charter and one didn't, right? And I think particularly getting a de novo charter, where there are some very specific steps you have to go through and some very specific requirements for the first couple of years after you get that charter, it really kind of handcuffs what you can do in terms of growing your business, right? And so Chime, I would consider to be similarly responsible, sober, relatively good products, sans credit builder. Like it's very similar. But to me, when I look at the two institutions and try to sort of note the differences, one of the biggest differences is that Chime has just been able to kind of like do its thing for the last few years, right? Like it's just been able to rock and roll. It can grow as fast as it wants to, assuming that its bank partners can hold up to what it's doing, and they've done a good job on the bank partnership side, from what I can tell. They can get really aggressive on marketing. I'm not a perfect test case for this because I don't think I'm necessarily quite in the demo that they're targeting, but like I would just say anecdotally, Chime's advertising and marketing just seems sharper and better and more aggressive and more sort of modern. Like I just think that Chime has been able to refine the non-bank parts of its business in a way that satisfies its investors and sort of gives it the patina. Now, again, we haven't seen underneath the hood of Chime too much, so we don't really know yet what the actual business looks like. But on the outside, it has the veneer of like going up and to the right. They continue to grow. Everything is moving in the right direction. And Varo, because it has this de novo charter, it hasn't had that same luxury, right? It's had Jason Mikula reading its call reports every single quarter. It's, I mean, yeah. Honestly, and like it's had to answer to regulators, and it's had to navigate, a whole set of different discussions in a very different way that I think has made an already slim proposition, which is carving out a profitable way to serve this segment of the market at scale. It has made that proposition, which is already very low odds, even lower odds, right? And so I think that's the number one thing that I see. And when you contrast it with, a SoFi or a lending club, these are two of my favorite examples for institutions that bought existing charters. They didn't go the de novo route. The difference there, the obvious difference is they serve a different part of the market, right? And they had already figured lending out and had sort of gotten kicked in the teeth with lending for years and had built really good models and ways of doing that. So they were much more traditional banks that just didn't have a bank charter or the full suite of products, but like they looked like the profitability profile of a bank. You could squint and you could see it. when you were looking at Varo, there was just no ability to kind of squint and tilt your head and go, yeah, it looks like a profitable bank. And if they get a charter, that'll make these particular metrics a little better and like everything will get easier. And again, credit where credit is due. I really give Varo a lot of credit for persisting through the process of getting a de novo charter, which post financial crisis has not been an easy or obvious path that a lot of others have taken. The persistence they've had in trying to grow this, their sort of steadfastness and not tacking crypto onto the offerings that they have, right? Like I give Varo a lot of credit for trudging through this very challenging path. But I think if we rewind to when they first were getting started and they were kind of trying to decide which path to go down, it's kind of a door A, door B situation. And I don't know that it was totally knowable at the time, but the door they picked just has not worked. It's really been more of an anchor around their neck than it's been like an accelerator to their business. And I don't think that's what they anticipated. And tying to your sort of most latest news on the equity fundraise, I don't know what adding more money to this at this point is going to accomplish. Like I could be wrong, and I hope that I am, but absent, and maybe this is why Colin Walsh was asked to step aside, and maybe this will sort of change with new leadership, but like they need a different approach to product development. They need a different approach to marketing because what they've been doing has not been working.
Yeah, I mean, two last thoughts on this. I mean, as far as adding more money, my strong suspicion is they probably had to, far as whatever capital level requirements they have with
they're a bank.
With the OCC.
They had to get more capital, right? Yeah.
Given that at the end of last year they had about $60 million in bank equity capital, and they would have, based on the burn rate, would have run out of money by the end of this year. Which, as a bank, not a good situation to be in.
No, in fact, the OCC really doesn't like that. Yeah.
I mean, as far as like thinking about, why didn't this work, or what could have been done differently? Your chart, the sort of charter versus non-charter argument, completely agree with the asterisks of like want to see Chime's S1, which I think is going to happen soon, and then to the extent that Varo went down this path of becoming a bank, I could think of two approaches that potentially could have made this go a little bit better, which is either, and of course easier said than done, but one, they needed to have a more diverse customer base, aka customers with more money on deposit and or better credit. And again, very easy to say that, very hard to do that, because if you're trying to win the cliche nurse, school teacher, firefighter who already has an account at whether it's a credit union, community bank, or big bank, they don't have the same set of challenges as the customer who has $65, in their Varo account. And so it's just more difficult to win those customers over who already have a reasonably functional banking relationship, or a more diversified set of products. And the example I would give there, again, easier said than done, would be what Cash App has done, which they're, starting with something that was peer-to-peer payments, so built-in network effects, very, very low cost of customer acquisition, and then backing into banking and lending. So Cash App had sort of a larger product ecosystem that, Varo started with this, checking account type product, and then tried to tack on these other things. And unfortunately, it stayed pretty constrained within this world of low income, low credit score, and customers who, in order to acquire them, Varo had to continue to spend a lot of money, and then a lot of those customers potentially were just fraud, which is very common in the fintech space, or ended up churning. But I know we're running a little short on time, so should we go to the grab bag?
We should. Yeah, Jason and I have assembled. By the way, I have to say this is an aside, but my wife loves grab bags more than anything you've ever seen in your entire life. Like, it doesn't even matter what's in them. Like, if you just give her like a random bag of stuff and it's a surprise, the surprise by itself is just delightful to her. So for listeners, we have assembled a grab bag. The theme of our grab bag is buy now, pay later, because there's been a bunch of buy now, pay later news. And we wanted to just reach our hands into the bag and see what we could pull out. So, Jason, you get first dibs. You reach your hand into the BNPL grab bag.
For sure. This actually has a through line to our first story, which I had to look back to see when the CFPB study on buy now, pay later usage came out, and it's dated January, which somehow it feels like that was like 6 months ago, but I digress. I know that you and I both read this, and I think we both wrote stuff about it, but I don't think we've had a chance to talk about it. CFPB put out a really, really good research report on consumer use of buy now, pay later. I would definitely recommend people who are interested in the space look at it because it has a lot of very rich data. And as a side note, I'd point out that this is the kind of research product that is incredibly valuable, not just to dorky analysts like you and me, but to policymakers and frankly, even to the industry itself, as far as competitors or other products, understanding how are consumers actually using these products. A couple of the nuggets in the report that stood out to me, particularly given how consistently the US buy now, pay later industry has used talking points about being better than credit cards or being a on-ramp to credit, were that 45% of BNPL originations were to deep subprime borrowers, and only 3.9% were to those that had no credit score, which to me completely rebuts the argument that BNPL is some kind of on-ramp to credit for those who don't have access versus a way for customers who are credit seeking to take on more credit. About a third of BNPL users have loans from more than one BNPL provider. So they're stacking loans from multiple BNPL companies. And it's true that BNPL default rates are relatively low, but it is very interesting and frankly worrisome that those who use BNPL are much more likely to default on their credit card payments, with BNPL users defaulting on their credit cards at between 8.7% to 14.7% in recent years. And last but not least, and I found this one very interesting, once somebody begins using buy now, pay later, their utilization of credit cards actually increases. So somebody is taking on debt with BNPL somehow makes them more likely to also take on more debt on their credit cards. So you're not actually necessarily seeing a substitution, which would be, okay, I don't have a credit card or I'm using my credit cards less. You're just seeing, obviously it's going to vary by customer segment, et cetera, but you're often seeing people use this as a mechanism to just take on more debt, which I would argue, is not a good outcome for consumers who fall into that bucket. So that is my grab bag selection number one.
That is a good one. That's a good one. I'll give my super quick take and then we'll move on to the next one. We won't belabor any of these individual stories, but I found the study to be fascinating as well. And I think the sort of meta point is that there is a pretty big delta between the way that BNPL is sort of positioned versus the reality of how it is used. And the way it's positioned is, hey, this is for people who either are new to credit, don't have any access to credit, and this is like an on-ramp and a better way to get into credit. Not the case, right, as you illustrated. Or this is also presented as this is a healthy alternative to credit cards, meaning, or the implication, and I don't know if I've heard anyone say this exactly, but the implication of that is a healthy alternative would suggest that you are actually succeeding in getting someone to switch off of the thing that was unhealthy and pick up the thing that's healthier. And this data would suggest that, in fact, this product is most commonly used by people who have credit cards, have credit card debt, and who are deeply subprime, meaning that they haven't performed well in managing that existing debt. And in some cases, as you said, the debt actually goes up after they start using this product. And so it does paint BNPL in this very different light. And I think one of the things that concerns me about BNPL is it is structurally safe for the BNPL providers, right? You and I have talked about this before, but it's like a pay in for BNPL loan is such small dollar and is so quick in terms of the term of the loan that it just sort of naturally limits the downside for the BNPL provider, right? And so the BNPL provider, in a way, can kind of come in and like scalp the last little bit of debt off the top in a way that's like safe for them from a risk perspective, but not necessarily in any way good for the end borrower, right? It's not like the best outcome for them, but it sort of allows the BNPL providers to sort of come in and like grab that last little bit of headroom before there's no more ability to lend to this individual, do it in a way that's low risk. And then, oh, by the way, and this is teasing something that I know is in the grab bag that we'll get to, we're also going to use credit bureau data to help us make our decisions, but we're not going to give any data to the credit bureaus to help anyone else figure out what we're doing to the mix or what impact we're having. So that, I think, all makes for a pretty potent kind of combination of troubling factors. So again, emphasize Jason's point about going to read that study and dig into it, especially since the CFPB might not be doing this work anymore.
Should we go to the next grab bag selection?
That's what I think. So I'm going to reach my hand in the grab bag, and a thing comes out that actually I saw you tweet about. I'm not sure if you've written about it. This is a firm partnering with FIS. So the quick story here is that a firm has partnered with FIS, the large core banking provider, one of the central suns that the entire financial services ecosystem orbits around. And this partnership will allow FIS to enable their debit card issuing banks to add pay later functionality to their debit cards without requiring them to replace or reissue those debit cards. So essentially, what this will allow is any bank that's issuing debit cards through FIS to basically offer their own version of the Affirm card, which has been this very successful sort of hybrid debit card BNPL product where you can use it as a debit card, but then at any moment, if you want to finance a specific purchase, you can do that either based on an offer that you got from a merchant. You can do that in advance and get approved by a firm to finance a specific amount, or you can go in and take specific transactions and sort of convert them into installment loans after they happen. This will allow those banks that issue debit cards through FIS to be able to do something similar. Now, we don't know exactly what the mechanics of this are, but my educated guess, based on prior reporting, is that it probably will use Visa's Flex credential, which now MasterCard has a similar thing that they've launched. I think you saw that. And in the background, that essentially allows for the same card number to sort of be flexed between different funding instruments, right? And so it allows for that flexibility. Interestingly, this is an example of that flexibility being leveraged by an issuer and a partner, not multiple products offered by that issuer. So this is kind of a slightly different derivation of what I had thought Visa Flexible Credential would be used for, but sort of seems consistent with this direction of the card becomes a pointer that can point to multiple different products or funding sources on the back end. And then it sounds like Affirm is supplying the credit for all of these, which is obviously a big benefit for Affirm being able to do this, as well as, if I read the press release correctly, Affirm being able to bring its 350,000 merchant partners into this new channel, essentially, so that they can offer merchant-funded financing offers, like 0% interest is a common one, directly to the end customers using these debit cards. So in that sense, it's actually sort of opening up all of FIS's debit card issuers as sort of new advertising channels for all of Affirm's merchants. So you can kind of think of it as like a new advertising network in some senses for Affirm's merchants. And then obviously for these debit card issuing banks, my view on it is that it allows them to sort of offer a supercharged version of their debit cards, which is interesting actually, because if you look at the split between debit cards and credit cards, most banks offer debit cards to consumers, even very, very small banks. They're usually not huge portfolios, but most banks offer checking accounts, debit cards. credit cards are much less common as you go down smaller and smaller, right? Like the credit card market is very concentrated among very large issuers. And so in some ways, I sort of view this as FIS and Affirm enabling smaller banks to have a payment instrument that's more of a compelling alternative to the credit cards that they know they can't displace offered by Chase and Capital One and American Express. Jason, what's your quick take on this news?
I'm going to pick the next one from the grab bag and combo it since it's thematically similar. So
Love it.
the next grab bag selection is Klarna, which signed a deal with JP Morgan Payments to make its buy now, pay later capabilities available to JPMC's merchants, with the integration expected to launch later this year. And my takeaway, like for both of these, is it's yet another data point in the sort of fierce battle for distribution in buy now, pay later land. Particularly when it comes to bricks and mortar merchants, where my perception, I couldn't find a quick stat on this, but my perception continues to be that customer usage of BNPL at physical retailers is just significantly orders of magnitude lower or more difficult to achieve compared to the original e-commerce, online point of sale distribution use case. And so here it's like, okay, if you are one of JP Morgan Chase's merchant acquiring customers, now you have the option, you have the opportunity to make Klarna's buy now, pay later financing available to your customers. I would sort of bucket this along with things like what Apple is doing, right? So Apple still somewhat weirdly to me abruptly abandoned its own offering in favor of a platform strategy and working with multiple buy now, pay later providers, as well as the flexible credentials you mentioned, right? So Affirm has its Debit Plus card, which has been getting quite decent adoption, and Klarna has its Klarna card, right? So, like at the highest level, at least for the buy now pay later providers, I view this as basically a war for distribution, with the big questions being sort of how successful are these channels. So in the FIS story, I'm assuming that the banks that are issuing those debit cards would need to opt in to providing this capability, and then presumably to have their users, their consumers take advantage of it, they need to be aware that it exists. So presumably there's also some kind of marketing or activation component to it. And similarly in this Klarna JP Morgan payment story, it's okay, I have no idea off the top of my head how many merchants use JPMC for merchant acquiring, but I'm sure it is a lot. But those merchants need to be aware of it, presumably activate it or opt in, and then make their customers aware that it is available. And so I think these partnerships are very interesting as far as distribution opportunities for buy now, pay later providers. And what I'll be watching is to see what is the uptake. Does it move the needle as far as their customers, their originations, and whatnot. The point you made on the FIS story, as far as the benefit to the debit issuing banks, is very interesting and not one, honestly, that I had considered. Which is sure, credit card space totally dominated by whatever the top 10 issuers, but every small town bank and trust credit union issues a debit card. And that is a very interesting point, that if they can now offer a feature that makes it more compelling, sort of more comparable to a credit card, but without having to take the credit risk, that is a very interesting opportunity for those banks. I really like that point.
Yeah, no, I think that's right. And I think the only thing I would add on to your analysis, which I completely agree with, is that in the case of Chase, I find it kind of interesting that they've opted to partner to do this rather than to build it themselves. And the reason I would contrast that with someone like like a US bank, right? The US bank has actually invested quite a bit in building out its own proprietary buy now, pay later and point of sale financing network. And they have merchants. They obviously work directly with consumers. They're trying to sort of assemble their own network and build sort of a smaller competitor to an Affirm or a Klarna. What this tells me with Chase is like, they're like, yeah, this is an opportunity, makes sense for us. Probably not something we should waste our time on. Like, this strikes me very much as like, we're Chase, we have bigger fish to fry. So why don't we let someone else do this cute little buy now, pay later thing with our merchants? We'll make a little money. It's good for our merchants, but like, it's not something that we feel we need to own. And so I do think, kudos to Klarna for getting into this. I've always perceived Affirm as being a little bit better at kind of partnerships and business development. So I think it actually does speak very well of Klarna that they were able to get this opportunity with Chase. And I completely agree with you about just we're chasing distribution and trying to get BNPL into every corner of the commerce ecosystem. And brick and mortar is sort of a big unexplored corner. Jason, do we have time for one more grab bag? Can I reach my hand in one more time?
One more. Super relevant. One more.
All right, he will allow it. All right. The story that I wanted to talk about real fast, which I did write about, so I won't belabor it too much, is Affirm doing a study on BNPL with FICO, my old employers, obviously the creator of the FICO credit score. As I referenced before, the BNPL companies have been very stubborn about not furnishing any of their data to the credit bureaus. The old version of the story was that the credit bureaus weren't ready to take that data. The more modernized version of the story is that they are now ready to take the data, but the BNPL companies have other concerns about sharing their data, which we could talk about if we want to. This study that Affirm did with FICO was sort of designed to, I think, try to answer some of the questions about what would happen if the BNPL companies furnished more of their data to the credit bureaus, and specifically what the impact would be on credit scoring and on consumers' credit scores, which is one of the big concerns I think that BNPL companies have. They don't want to see their customers' credit scores get dinged because they started furnishing data. In fact, in a lot of cases, the way BNPL was marketed was this won't hurt your credit. So, furnishing data would be sort of going back in some senses on that brand promise. So the study, which was done, I believe, over about 12 months, basically took a bunch of Affirm data, and FICO looked at different ways of sort of incorporating this data into their models and seeing what the impact would be. What they found was that they developed what they describe as a proprietary treatment to harness the benefits offered by the incorporation of BNPL data into consumers' FICO scores. The research showed that this treatment can improve model performance, so make the models better at sorting goods from bads and rank ordering risk, and lead to increased FICO scores for some BNPL borrowers. And I would interpret that statement to mean, on average, it's probably more positive than it is negative for BNPL users. Adding data to the credit file, someone is always going to lose if it's helping you make a better decision. So it's never universally going to be positive, but it sounds like the way that FICO envisions doing this, it would be more positive than negative for BNPL providers. A couple of questions about this that I have. One is, what is this proprietary treatment that they're using to get the data into the credit files and then into the scores? My understanding from reading the press release and then talking to a few folks in this space is that it's actually fairly simple. They basically just combine a bunch of individual pay in for BNPL loans into a single personal installment loan. Now, obviously, a personal installment loan is something that the credit bureaus know how to handle. It's something that is compatible with the current version of the FICO score and all of the older versions of the FICO score, going all the way back to FICO 8, which is still the most commonly used score in the market. So it's compatible, it's backwards compatible with many, many versions of the FICO score. And it's kind of sounds like the easiest way to do it. Now, what I can tell you is, from having talked to a lot of folks in this space, this is not like a new idea. This is one of the first things I think that the credit bureaus also looked at when they were trying to figure out how to incorporate BNPL data into their data file. And the reason I think they haven't been advocating for this approach is that it creates some accuracy concerns, right? So, Jason, as you could probably imagine, it gets a little confusing when you're aggregating a bunch of individual loans together into one that's going into the credit file, right? Questions like, is the consumer going to recognize this thing that's on their credit report? Because in their mind, they go, hey, I got a $180 loan from a firm to buy, a pair of tennis shoes. Why does it show I have a loan for $970? Oh, that's all of these loans combined. Is that accurate? Is that the right number? Now I have to go back and look at all the other Affirm loans I had and add them up. So it starts to get a little confusing from a consumer perspective, which is actually very bad for the furnisher of the data and for the credit bureau, because if there's any disputes around accuracy, they have to deal with those. So consumer confusion is a big deal. And then even just like the accuracy of the data and decisions you have to make about it get pretty tricky, right? For example, when do you de-age the credit line, right? Like, what is the total age of the credit line? Is it when you opened the first one of those BNPLs? Is it when you paid off the last one? Is it averaged across all of them? So when you aggregate together, you have to make some choices about how you calculate it that create accuracy concerns. So I don't necessarily envision the credit bureaus being easy to sell on this idea, even if Affirm and FICO were all for it. And obviously, at the end of the day, FICO can encourage this as the solution to this problem, but it's the credit bureaus and the other BNPL providers, Klarna, Zip, now Block, Cash App, they all have to collectively be on board with this as the model for furnishing this data. And I don't get the sense there's a lot of agreement here. So I think this will probably nudge the conversation forward, but I don't know that FICO has uncovered sort of a silver bullet for this problem.
Yeah, I mean, as is normal, agree with all of your points, particularly as far as some of the potential consumer issues or consumer confusion, depending on how these trade lines manifest in a service like Credit Karma, and whether or not somebody recognizes it, understands it, agrees with it. If that causes a spike in dispute activity, that's not going to be fun for the furnishers to deal with. I also, again, have been around long enough that I'm just sort of like inherently skeptical of studies that say exactly what the company that is participating in the study wants it to say. And the press release, as I recall, didn't really provide a lot of detail about the methodology of how FICO and Affirm went about doing this.
Yeah.
I recall, this is a million years ago at this point, and I didn't run this project when I was at LendUp, but we did a similar kind of study to attempt to understand, what was the impact on, LendUp users' credit score from certain like patterns of usage behavior, or if they graduated to like the top tier of product. And, there's a whole lot of interesting things you can do with statistics to try to drive towards the answer that you want. I'm not saying that that's what happened here. I'm also not a statistician or a data scientist. I just, when I see something like this, my skepticism hat goes off, and it's like, well, like, this could be true, but really they haven't provided enough information about how they undertook this study for me to automatically want to believe that the answer they've arrived at, which just happens to conform with sort of like their PR, comms, marketing position, is actually like reflective of reality. And I would even venture to say, like, that's not really what the point of furnishing is. And I'm confident you'll agree with me here. It's like the point of furnishing is not make Affirm buy now, pay later users' score go up. The point of furnishing is, one, help potential creditors make better, meaning more accurate lending decisions, even if that decision is no, I will not lend to you.
Yep.
And two, I'm sure it doesn't feel this way to a person who is applying for credit and is declined, but part of responsible lending is being able to accurately calculate an applicant's ability to pay, and not having entire sort of segments of information, including buy now, pay later. But there's other things. Payday loans historically are not present in the main bureau file; they're in specialty bureau files. Having that data available to lenders helps them make better decisions, which one could argue, and I might be that person, that this helps protect consumers from becoming overly indebted by not continuing to extend credit to them that they may not be able to afford to pay back. And I realize that's probably not like a super popular point of view, but like the point of the Bureau and credit scoring data is not like, yes, everyone should get 850 FICO so that they can qualify for every product they want. Like that's not what the system is designed to do.
I couldn't have said it better. I totally agree with you. I know we're just constantly agreeing with each other all the time. I think the only thing I would just add to what you said is that there is a real sort of bit of game theory going on here, right? In the sense that it sort of makes sense in a global sense for all the BNPL companies to provide all of their data to all of the credit bureaus so that everyone in the ecosystem can see what's going on and everyone can adjust their models, right? So like if Rohit Chopra, who's now out of a job, could have waved a magic wand and made something happen, that probably would have been the like, this is the best answer for the whole ecosystem. But the game theory comes in terms of whose individual incentives are aligned to do what when, right? And I do think it's interesting that every one of the credit bureaus has said they have a different answer to this problem, right? They don't all agree with each other about the right way to handle taking in BNPL or other novel types of credit data. They all have an incentive to compete with each other to build the best profile of data, but they also have an incentive to compete with each other to get the business of the BNPL companies who want to buy their data when making credit decisions. The BNPL companies all compete with each other, but they operate in slightly different segments of the market. They don't necessarily want their competitors seeing the data on their customers. So none of them want to go first. And if they were to go first, they might just cooperate to share data on a small segment of like super heavy BNPL users that they would consider more like first party fraud than credit risk. And maybe they just share that among themselves, but they don't make it available to the market. So there's all these very weird incentives that aren't aligned. And so the fact that this was a study done just by FICO and Affirm, didn't include any other BNPL providers, and didn't include any of the credit bureaus, sort of suggests to me that it is part of that game theory and everyone trying to sort of nudge the incentives in the market in a direction that's going to be good for them. So we will see what happens. Obviously, if the CFPB as an organization just ceases to be a thing we talk about, then maybe no one feels any pressure to furnish any data to the credit bureaus anymore. But Mr. Mikula, before I let you go, just rant about something you can't let go. What's bothering you?
Well, if anyone made it this far. Okay. So somehow you and I managed not to talk about debanking in this episode, which I'm actually thankful for. But I did put myself through watching a lot of congressional hearings in recent weeks. And I have to say that in general, they are an utter clown show waste of time. And unless you have like a high tolerance for pain, like I would not do that. However, I will say Fed Chair Powell's, I think it's like a semi-annual trip to the Hill, is actually worth watching. It's quite interesting. And my can't let it go is there was one question from Tennessee Congressman John Rose asking Fed Chair Powell how he or how the Fed would make sure that another synapse doesn't happen. And Powell's answer, he responded by saying, quote, "When we see things, it's a lot of pattern recognition. So we'll be looking to avoid things like this happening in the future," end quote. Which I just God. I think I literally burst out laughing at that point in the hearing because it was just like the most word salad, like non-answer. Like, oh, one, we don't even really have a clear agreed upon reason why this happened. And you're telling me that the Fed's, the government's approach is going to be looking to avoid it happening again? So yeah, I will leave it there. What can you not let go of this month?
I mean, I feel like I can't get away from crypto no matter how hard I try. It's like sucking me in. But my can't let it go is the sudden turn that many in the crypto ecosystem have made just in the last day or two on meme coins. So this might be slightly old news by the time folks listen to this, but and I don't even know really the details. There's something to do with like a Libra meme coin that was somehow tied to Argentina, which has created this whole government crisis in Argentina. And then also like the Melania coin, and it was all happening on Solana. And there's some, guy who like was just sort of a grifter who came out of nowhere but managed to like pull off this like really like impressively grifty grift of meme coins. And I guess this was too much for even people who were previously defending meme coins, even like as recently as a couple of days ago. Now they're like, oh, this is too much. This is the straw that broke the camel's back. And my statement to them is, welcome to the fucking party, pal. We've all been here for so long on meme coins. It's such a transparently bad idea that rips off retail investors. And it is, quite frankly, embarrassing to me that it took so long for you to be embarrassed by this thing that should have been embarrassing to you a long time ago. Like, I think I tweeted about this, but if you wanted to know, previous to this happening, how to tell serious crypto people from non-serious crypto people, ask them about meme coins. And if they even like hinted at trying to defend them in any way, shape, or form, you need to run as far away from them as possible. Now, because of the fact that I guess the government of Argentina has been dragged into this, people are starting to give their distance a little bit from meme coins finally. So we'll see if that means anything or if retail will be able to sort of not get sucked into it quite so much. But I think that might have been the top. So anyway, can't let that go. Probably going to think about that for a while.
Will use that as my litmus test from now on. When I get stuck in a conversation with a crypto person, just like ask their point of view about meme coins, and then
ask them like what their
answer,
favorite one is. Yeah. Just be like,
just walk away if they answer wrong.
You have to, unless they like scoff and be like, it's an embarrassment to this industry. You just walk away because they're, and I'm not trying to, demean the entire space. I'm sure there's one or two that are good, but it is awash with grift and scams in a way that is just bad for everyone. And so, apparently, maybe the worm has finally turned and folks are becoming more aware of that. I'm sure I'll have some new thing to rant about next month. But until then, Mr. Mikula, I am so looking forward to seeing you in person. Folks out there, if you still haven't gotten your Banking as a Service book that I know a lot of people have now received and have been enjoying by Mr. Mikula, buy that book, bring it to Vegas, get him to sign it. It is wonderful. And Jason, I'm sure a trip to Bass Island is somewhere in our future. So until then.
Absolutely. There will actually be a book signing at Tactile's booth. So keep your eye out for the details of that. Gotta get my plug in.
All right. That's a great plug. Yeah, I will be first in line for that. That sounds amazing.
All right. Can't wait.
All right. Thank you.